Good afternoon, everyone. Thank you for spending your precious lunchtime with us today. My name is Hugh Chung. I'm the Chief Investment Advisory Officer in Dallas. Today, I'm joined by my colleague, Yulin, who is an investment lead at Endowus. Before we talk about our subject of rate cuts, which happened overnight, 50 basis points, we will go through a disclaimer as well as a brief introduction of Endowus. Next page, please. And for the whole time, you can participate in your questions using the Slido app, as you see on the page here. Yes, so we move on to the next page. So as most of you will know by now, Endowus stands for Endowment Investment for All of Us. So it's really empowering individuals to have conflict-free advice, institutional access, and low fare fees, like the institutions and the endowments do, provided to the individual levels. The biggest shareholders of our company are still Endowus employees, but we have some great investors such as UBS, Citi, Singtel, and many others in our cap table as well. Next page. So as you can see, we are a digital platform using the app, making the investment experience very easy and easy for you to maneuver yourself. Next page. So with that, we will look at some historical examples of rate cut cycles and asset class performances. And after that, Yulin will go through the impact, particularly on fixed income. So when we look at the historical cycle from 1990 onwards, so over the last, let's say, 35 years, we've seen 6 rate cut and 6 rate hike cycles prior to the one that we saw from yesterday. And if you look at those examples, you can see that every rate hike and cut cycle is different. But you'll notice that the latest one, the latest rate hike cycle, was actually very, very steep in the time period that it went through. So it went through a period of 16 months, but it had a 48 basis points average rate hike, which is actually very, very steep. Going to the next page. But when we look at just the rate cut cycles through the averages of the 6 rate cut cycles, again, you'll notice that every rate cut cycle is different. But on average, in the blue bar chart that you see in not the dark one, but the light blue bar chart, which are global bonds, you can see that every single rate cut cycle bonds had positive performance. Compared to that, the equity markets or the stock markets have seen very mixed performance. The latest rate cut cycles have been involved with recessions, which is during COVID, as well as the great financial crisis in 2007 and 2008. Those were periods where equity markets were weak. But barring a recession, we actually saw positive performance in stocks as well. So you'll notice that bonds overall show positive performance in every rate cut cycle, whereas stocks, it really depends on the growth outlook. If you look at the next page, you can see this more graphically in a study that was done by Goldman Sachs, that during a period when there is a recession, which is in orange, you can see that the next 12-month performance is weak, but over a 24-month period, it actually tends to come back. But when there is no recession, the average performance tends to be quite solid, as you can see in the dark blue. But the other observation here is that the range of outcomes, which you see in the light blue, is quite wide. So if you look at the 25 and 75th percentile of all the rate cut cycle outcomes of equity markets, you can actually see that depending on the growth outlook, it is quite wide. And we will go through some implications of equity markets at a later stage, but maybe I'll turn over to the next page and give the stage to Yulin to discuss cash versus bonds.
Yeah, thank you, Hugh. Hi, everyone. I am Yulin, and I am investment lead at Endowus. So I will be walking through the implications of rate cuts on cash versus fixed income. And I have already been seeing some questions coming in, and I hope that we will be able to address most, if not all of your questions throughout the presentation. So as Hugh mentioned, we have just gone through a very aggressive rate hiking cycle, and that has really shaped investors' mindset and consequently portfolios in meaningful ways. So as the cycle turned, we think it's a necessary time that we unpack the hidden assumptions and risks and have a fresh look at our portfolios. And this is when the discussion of cash versus bonds comes into the center stage. Next page, please. So one profound impact of the last 2 years hiking cycle is that many investors are now over allocated to cash. Cash rates have been really high, even higher than fixed income rates. Seen as the risk-free asset, retail and institutional investors alike have been piling into money market funds, and now there is more than $6 trillion just sitting in cash-like instruments. I believe many of the audience today would have invested some of your cash in T-bills or fixed deposits or money market funds somewhere during the past 2 years. And as the Fed has started cutting rates, more investors will realize how fleeting high cash rates are and the high and rising opportunity cost they are exposed to by staying in cash. Next page. So the short-term nature of cash investments and falling interest rates have really made them particularly susceptible to this risk called reinvestment risk. So historically, when central banks cut rates, yield on cash investments also decline. Actually, I was checking the 3-month T-bill rates just overnight, and it has declined on the back of the rate cut. And this means that if you currently have maturing cash investments, you may struggle to find new opportunities that offer the same high yields as the old ones. And we are actually living through a really unusual period where cash has been particularly attractive. So this chart plots the historical yields of 6-month US Treasury bills and the 5-year US Treasury bonds. As you can see, short-term cash yields have been higher than longer-term bond yields. However, history tells us that such unusual episodes are relatively short-lived. So going back to history, we can identify 12 similar episodes going back to 1970s. And on average, these rare occurrences lasted about 7 months. The current one has already endured for about 2 years. How much longer will it last? So reinvestment risk has the potential to significantly impact overall returns over longer-term horizons. Here is a case study for you to consider. So consider the peak of 6-month US T-bill in October 2000, and that was marked by the first yellow dot. And we compare the returns of an investor who purchased a 5-year US bond, Treasury bond, and just held it to maturity, with those of the investor who purchased the 6-month US T-bill at the same time and then reinvesting the proceeds in a new 6-month T-bill at the prevailing market rate each time the current one matured over the same period of 5 years. And the investor who purchased the 5-year Treasury bond in October 2000 would have locked in a yield to maturity of 5.8% per year. The investor who purchased the 6-month US T-bill would have received an initial yield of 6.4% per year on the first 6-month bill. However, because of the subsequent changes and declining of yield, he would only have received an overall average yearly return of 2.4%. So that opportunity cost is almost 3% per year, and that is more than 15% for 5 years. So the bottom line is that the opportunity cost of chasing high short-term cash returns while ignoring reinvestment risk can be substantial. And this is why the discussion of cash versus fixed income becomes extremely relevant, as fixed income is a longer-term asset that plays a key role to shield long-term investors from reinvestment risk. Next page, please. So now let's take a closer look at the risk and return of fixed income versus cash. Next page. Higher returns typically comes with higher risks, and this holds true when comparing fixed income investments versus cash. So this chart plots the cumulative excess return of global bonds versus cash for the past 15 years. On the return side, fixed income has historically outperformed cash throughout policy cycles. Not only do fixed income outperform cash over the long term, bonds have beaten cash most of the time. However, on the flip side, in terms of risks, fixed income does carry interest rate risk and credit risk, and it can underperform cash in extraordinary times, including what we have just witnessed in 2022, a very unfavorable market environment for fixed income because of the interest rate hikes. Next page. Let's take a look at the different fixed income sectors' performance after historical rate cuts. So the chart plots the average 3-year return of fixed income sectors of various credit qualities following the first rate cut. In particular, the green bars, the dark green bar also plotted the cash return for the same period of time. As you can see, following the first rate cut, most fixed income sectors generated attractive total returns, often outperforming cash. And a short explanation on total return of fixed income, it actually consists of two components, income and capital gains or losses. So income is driven by the coupons paid and will not change unless the bond defaults. Capital gains or losses are driven by interest rate movement. When rates decline, bond prices would actually increase and vice versa. And the good performance of fixed income versus cash in the past cycles has been driven by a high starting yield, which will affect the income component, and also the potential price appreciation due to the falling interest rates, enhancing total return over that period of time. And for this cycle, we have received some client questions regarding whether bond prices have appreciated and hence it's too late to enter, whether the market has already priced in 200 basis points of rate cut, so there is little room for capital appreciation from here onwards. I guess the reality is that there is a lot of uncertainty around that, especially uncertainty for the longer end of the fixed income yield. It will really depend on how the inflation growth expectations evolve as we get more data in. And bonds at different maturity levels will also not move by the same degree. It is true that actually bond prices have rallied a lot already as market has priced in rate cuts. And there are voices even saying that, oh, this might be overdone. There is also a chance, though unlikely, that inflation will come back and yields will go up again, causing bond prices to decline. So after all, maybe investors shouldn't be overly excited or worried about price appreciation or depreciation and remain vigilant on that front. But income is definitely back and is something long-term investors don't want to miss. And we will speak more to that later. Next page. So now if you are thinking about moving ahead to fixed income from cash, we do have a range of solutions for you to consider. Most importantly, we would like to encourage our clients to consider your investment horizon, objectives, and risk tolerance before investing. Next page. So here we have plotted an illustrative risk and return map for selected fixed income options on the platform. We have over 200 funds actually on the platform, so there's a wider range to choose from, but these are just the selected to give you a sense of what we have to offer. So for those looking to move out of cash gradually, consider adding some short duration fixed income to your portfolio. They are suitable for conservative investors with a relatively short investment horizon. Our ready-made advice portfolios such as Cash Smart Enhanced and Ultra comes with a mix of money market funds and short duration funds. We also have individual short duration funds like United HGD Fund and PIMCO GIA Slow Duration Income Fund, and they're available on Indara's Fund Smart platform. For those who have a longer investment horizon and are ready to take on higher duration and hence interest rate risk, consider the Indara's flagship 100% fixed income portfolio, and that's available for all sources of wealth, cash, SRS, and CPF. This portfolio offers globally diversified exposure to high-quality fixed income instruments, including government and investment-grade corporate bonds. The PIMCO GIS Global Investment Grade Credit Fund, investing only in corporate bonds, provides exposure to intermediate duration as well. And all these options have no lockup period and offer daily liquidity. Indara does not charge upfront sales fees and returns all the trailers fees to clients as cashback, ensuring the lowest possible cost for our investors. Next page. So now a very popular market timing question is, when should I move? I have briefly discussed it just now, but to unpack it further here, the potential reason why investors are delaying are either, first, you want to wait until fixed income yield gets a bit higher than now before you lock it in, or you want to wait until cash rates come down enough before you move to fixed income. And for those thinking in the first category, I want to remind you that market is notoriously hard to predict, especially if you are just a retail investor. Next page, please. So this is a hairy chart. I call it a hairy chart. It shows you the market participants' average expectation on the Fed's fund rates over time, and those are the little blue lines. First is the actual realized rates in the solid black line. Very rarely you can see the market participants could get it right on average, and they're really biased to what has happened recently. So unless you really think you can predict better than the average of all the fixed income investors, and you have a strong thesis backing it up, it is really pure luck. For those wanting to enjoy cash rate for longer and wait a bit more, by the time the cash yield comes down, long-term bond yields may have also dropped, causing you to miss out on better reinvestment opportunities. Next page, please. So I guess instead of obsessing over the perfect entry point for fixed income, stay strategic in your asset allocation and think about how to use the investments to match your liabilities over different periods of time. And really just take a step back and see that actually now fixed income has income. The chart plots the treasury yields for the past 5 to 10 years. Actually since 2008, so since financial crisis. And you can see that fixed income yields are at the highest level since the global financial crisis, during which the zero interest rate policy was introduced. And just 5 years ago, investors had to go down to junk bonds, like high yield bonds, to just get 4 to 5% yield. And now investment grade bonds are offering a similar level of yield. It is truly an exciting time, but it's not going to last forever. And I hope we don't miss the forest for trees. So next, I know people might also have questions on equities, and I'll hand it over back to Hugh to talk about equities.
Yeah, thank you, Yulin, for that detailed explanation on fixed income. We have been getting some questions already on Slido in terms of whether this is a good time to go into markets, equity markets, S&P 500 in particular, and also how we think about different macro environments that impact equities. Like I described, growth is a very, very big factor that drives equity returns. So maybe with going to the next page, the first thing I wanted to really address here, though, is that when we ask a question on whether equities are good or bad, is it the right time to buy or not, I think it's really important for us to consider what our goal is. Like, what are we trying to achieve? If your goal is very long term, the answer to that question of is it the right time to buy S&P 500 is a resounding yes, right? Evidence has shown that time in and time out, the longer the investment horizon, the hit rate of having a very positive return is very, very high. So what we wanted to address here is first and foremost, before we look at whether a certain asset class is right for us or not, we have to establish whether our goals are in check. So is this really money that I need very quickly? In which case you have to have it in the safest form, which is still cash. But then if it is an investment that you can hold on to for more than 2 years, etc., then you start moving into fixed income and other areas in the asset class. So I think that was the first thing that we wanted to address. As you see here, depending on the investment horizon, the allocation to blue in stocks here increases. Now, this is not a formula for everyone, and everyone's risk bucket and risk appetite is different, so it could be a little bit different, but it's a guidance to how you think about these investments. Next page. So I just wanted to go back to a chart that we showed you earlier, again, just to see how equities would fit into the framework. And global equities over time has returned, say, an annualized 8% type return. So again, if you stay invested in compound, equities is really the best vehicle to compound growth over time. The problem is people are worried that valuations are high, or we're buying at the top, or if a recession is coming, then the returns near term may not be good, and these are all valid concerns. But again, what we wanted to show you here is that if you put it into that goal basket, again, the longer you invest, equities will do what it's supposed to do over time. Now, just from a macro perspective, my view is that actually the reason why the Fed had decided to cut rates is really symbolic in nature as well, to show that we have actually finally overcome inflation, or the bigger risks of inflation that came from the supply imbalance that we saw through COVID. So I think that's very, very important. But I think what's important to also note is that if we just look at a very short history, it may look like rates are coming from a high place and we're coming down. But if you look at a much longer history, actually the current interest rates, the current inflation, and a lot of other economic data is very much normal, right? So a 4% type interest rate, 5% type interest rates have been a very normal interest rate environment during the 90s and a long time ago, right? So I think it's important to have that in context, that a lot of what's happening right now is normalization, right? So I think that's a very important context. And there were some questions on Slido already on, what are neutral interest rates going to be like, and how are some of the different factors like deglobalization and other factors going to impact interest rates and inflation. And a lot of them, I don't think anyone knows for sure, but I think it's very, very important to look at the current indicators in context of a much longer history, and that suggests that we are in a fairly normal environment. I think the U.S. consumer is still relatively solid. The economic numbers that are coming out are definitely slowing down, but still at a pretty healthy level. So on balance, I feel like it's the right time to still be invested in a diversified set of global equities for those that have investment horizons and goals that fit into equities. So, I hope that gives you a bit of a picture that equities are also a very, very important part of your asset allocation in this period of rate cuts. Next page. With that, I think we will open it up to questions. Just as we reminded, Slido is open for all of you to ask questions. We will just check to see.
So we are receiving a lot of questions, and some are similar, but some are different. And I think actually we have addressed some of the questions during the session as well. Maybe I'll get started while he looks at the questions. So the top question that has been upvoted is, market is expecting Fed to cut more 200 basis points by next year. How much have this been priced into the bond markets? Very good question. And yes, market has been pricing in rate cuts quite aggressively. in the past few months. Actually, as we saw the Fed coming out of the meeting, and the Fed dot plot suggests that the median kind of forecast amongst the committee member is 50 basis points cut by the end of the year, but the market is on average pricing about 70 basis points cut by the end of the year. So there's a lot of uncertainty, and actually, if you look in details into the next year's projection, the market is pretty split on the outcomes. There is no like overwhelming forecast in terms of how much basis points we will get to by the end of 2025. So as I mentioned, I think instead of really focusing on getting that capital appreciation from a downward surprise of the Fed cut, it is really important that we take a step back and see that actually yields are still very attractive. It can move sideways, it can move down or up in the next 3 months, 6 months. No one will know. It's really, really dependent on how the data comes out to be and how market reacts to it as well. A lot of factors in play, and it's important that we understand what is our return objective and how much risk we should be taking at the current moment to achieve that return objective. It's very dangerous to want to be tactical and go in, and the market moves against you in the next few days, and you'll be sorry in the next short period of time, and you'll be disappointed. So yeah, I would say focus more on the strategic picture of where yield is at and how much risk you can take, and go from there. Anything to add?
No, I was just going to add that there was another kind of related question that's broadly not just fixed income, which is the rate cut bullish or bearish given our current economic climate? And like a lot of the evidence that we've seen, it is pretty, consistently bullish for fixed income overall. And even though some of it is, or a lot of it is priced in, like Yulin suggested, the headline yield, starting yield is very healthy.
Yeah.
So we're having income for the first time. So it is a very kind of steady, positive investment you can consider. But for equities as well, I would say that assuming this current global economic condition continues the way it's been, I think on balance, the likelihood of a very steep recession is quite unlikely. So with that in mind, going back to the outlook of growth, it does look more on the bullish side for equities as well. So I would say on balance, to answer this question, the rate cut is bullish. I mean, I think it would have been more concerning to the market if the communication of a 50 basis cut rate cut was not communicated beforehand, or market wasn't expecting it. So for example, if last night the Fed cut by 75 basis points or something higher, then it could have, had a bit of alarm bells. But I think this was well within expectation, as well as the fact that I think another question that people may have asked is that the last 2 times when there was a 50 basis point rate cut, which was COVID and the global financial crisis, there was a recession. So is there going to be a recession this time? I think every time is different. I think COVID was obviously an unexpected event. And if you look at the financial crisis, is coming off of an unwinding of leverage and a lot of different problems in the system. Whereas right now, it was really because a very rapid rate hike cycle that was caused by COVID, essentially because of the supply imbalance, is normalizing, right? So, and I think there's an element of potentially the Fed being late, et cetera. So I think it's hard to extrapolate historical instances to this particular time. So all that to say, I think it is still a very good idea to try and move your cash into fixed income and into equities as well, depending on your risk appetite.
Yeah, and actually, I just wanted to add on to what Hugh was saying. I think the Fed dot plot is suggesting a more soft landing kind of scenario going forward, and we can of course, also see that actually the Fed has shifted their focus from controlling inflation to like supporting the economy such that it can land softly. Of course, there is always a downside risk towards that if the economy turned out to be weaker than expected. However, that is actually when fixed income will outperform in those scenarios, because recessionary scenario is generally bearish for equities. However, it's good for fixed income because that means that Fed probably have to cut more aggressively, and that will surprise the market. And then bond will actually benefit from the price appreciation from that. So it's a really good hedge in a really, really hard landing scenario against equities. And of course, in terms of the allocation, something for you to consider whether you want a mix of, fixed income and equities to create that kind of balanced portfolio, or otherwise.
Maybe do you want to take a question on how locking in bonds
Yeah.
means?
Yeah. So there is a question on what does locking in bond prices mean? How does it work for a bond fund versus individual bond? Okay. Yeah. So actually, we can talk about like the mechanism of how a bond works and also how a bond fund works. Essentially, what it means is that bond is basically a contractual agreement between the borrowers and lenders. And if I am a lender, as an investor, I'm lending money to like governments, to corporates, and then they will promise me to pay me interest at a certain frequency, semi-annual or annual. And also by the end of our term, and that's the maturity, by the end of the maturity of this bond, this contract, if the borrower is credible, the borrower should return me the principal. Right. So currently, basically, what has happened is that interest rate component has really come up because Fed has hiked interest rate. So maybe 3 years ago, if I am lending money out, I can only get like 1% interest, but now I can get 3% interest back. And by actually investing in bond now, I am able to lock it in until the end of the term of the bond. And that's what we mean by locking in the yield. And the price fluctuation in the meantime will not really affect you if you hold it to maturity. Of course, it will affect you if you want to sell this before maturity. So let's say if I buy the bond at $97, I buy it at a discount because usually bond is issued at par. But if not a lot of people want to buy it, then the price will drop until the demand and supply matches. So if I buy it at $97 and I get the interest of 3%, then by the end of the term I would have been getting 3% interest every year, and also the 3% capital appreciation from $97 to $100. And that's how bond works. And during the term of the bond, the price can actually go up if it's overly bid to like $102. And at that time, I can sell to lock in that capital appreciation as well, and then move on to the next opportunity. Or I can just ignore it and I will hold it to maturity, whatever. So I think that explains the mechanism of how a bond works. And there's quite a bit of difference between buying a single bond, an individual bond, versus purchasing a bond fund. So individual bond is actually a very concentrated investment, and it requires a lot of active monitoring from the investor side. You need to be quite sure about the credibility of the company that you are lending to, and also you basically need to put in quite a big chunk of capital from the beginning just to get that one single bond. Well, however, if you are buying a bond fund, actually you are outsourcing that kind of selecting and monitoring to a professional fund manager who is obviously better at picking bonds than individual investors like us, and they can also actively trade. So instead of holding to maturity, they can actually capitalize on the capital gains and moving on to the next attractive opportunities. And that's why their objective is not just to get market-like return, but usually is to outperform the market by employing different active strategies. People are also wondering, what part of the maturity, the curve I should be buying. There's different dynamics at different parts of the curve, including the really long end. People asking about the debt dynamics, the de-dollarization, how that will impact the really long end of the yield. And that's something, to be honest, everyone has been thinking about and asking, but there is no conclusive answers as to how that will play out. And that's when we actually probably don't want to put too much of our own view on it, but to try to give this hard problem to the fund manager for them to really put their resources to do their research and think about it, and then helping us to allocate our investors' money to different parts of the bond market to capture the most attractive risk-adjusted opportunities. And also for a bond fund, the minimum investment is really low in Dallas. You can start investing with $100 in Singapore, and I think a little bit, 1,000 Hong Kong dollars in Hong Kong. So it's very low, and the entry barrier is almost non-existent, and it's daily liquid. So yeah.
Right. Let me address a question on equities. So I think there's a question on how will 50 basis points cut and a total of 100 basis points by the end of the year affect technology and Max 7 stocks? How about small caps? Will they be bullish? So I think my answer is going to be a little bit more nuanced. I think there are maybe 3 different ways to interpret an interest rate cut on equity markets. One is the the debt servicing, right? The interest rates that some of these companies have to pay. So that'll have an impact. So that'll overall be positive, obviously, if rates go down. The second thing is the discount rate that the companies are valued at, right? So as you know, the worth of a stock is the discounted kind of cash flow, future cash flow. So that as the rates are lower, that improves or increases the value of the company. So that's another one. But the third thing is, again, the reason why there was a rate cut in the first place, right? It normally is because growth is slowing down, and in the worst case, it's a recessionary environment. So that's why the answers tend to be a little bit nuanced, and it really depends on what the situation is and how we've explained whether growth is still reasonably okay or whether it's in a recession. So if we go by the base case view that growth is still going to be okay, I would think that it is bullish for small caps as well as other types of sectors that have been a little bit compressed because of high interest rates environments, which is getting alleviated. Now, for technology stocks, again, from a discount rate perspective, it should be positive. But remember, another reason why the larger technology stocks have been trading at a premium, so to speak, is not just because of their growth perspective, but it's because of their quality perspective, meaning they have strong balance sheets, strong cash flows, etc. And that's why even during a rate hike cycle, some of them have done really, really well. So that is also a bit more nuanced. Biotech is another sector where interest rates have a pretty strong correlation to performance, given that the revenue is actually relatively inelastic to GDP, but the discount rate affects it, right? So again, it's very different for different sectors. On balance, I would say without a recession, it is positive, but our recommendation overall would be to stay in a globally diversified, sector diversified portfolio where you actually benefit from the longer term compounding of global equities, as opposed to wondering whether which sector is good or bad. Like I described, it's very nuanced, and it's actually quite tough to beat the markets by going overweight and underweight different sectors.
Yeah, completely agree. We have a question on REITs. Are REITs already overpriced? Which REITs are good to go into right now? And I think that goes back to your point on not betting on single sectors and staying globally diversified, because it's really difficult to tell how this cycle will play out for different sectors. Although I guess for REITs, we were just talking about yesterday actually. So it has had a pretty good past 2 month performance. I think if you look at global REITs, it's up 6% already. And however, it's been pretty depressed for the past 2-3 years. And we were saying that just from a pure PE perspective, price to earnings perspective, it's still a lot cheaper than the large cap global equities. So it's one thing to consider. And if you put that into perspective, it's probably not overvalued. And if you compare it to the private sector valuation, which tends to be reflecting a fair value without market impact, it's below the private sector valuation. This is not a call for you to like just go and buy, but I think it's important that you know that REITs overall is still a very volatile sector. It's still equities and has high beta to the equity market. So you're still taking a lot of equities risk when you go to REITs, and instead of just putting money all in one sector, it's probably wise to diversify your risk a little bit. Yeah.
Let me address an interesting question that compares with private credit. So the question is, what's your view on the rate cut implication on the outlook for private credit? So a big part of private credit is actually floating rates. So because you're actually directly lending to a lot of private and smaller companies, there is you can think of it more like a cash plus type product. So as some of you may know, private credit funds have been offering very, very strong yields over the last few years because cash rates have been high, and you get a spread on top of the cash rates because of the liquidity premium and many other reasons that they can charge that spread. So that overall yield of private credit will come down as rate cuts happen. But just to give you some context, private credit through the cycle, most private credit funds would say through the cycle they will give you returns of anywhere between 7 to 9%. And this is also during periods where interest rates were zero. So it will come down from the kind of low double-digit returns that some of them have been showing, but it'll still be at a premium to the kind of cash rates and the other short duration public bonds out there. Now that is quite different from public bonds that, like Yulin explained, move differently when rates come down. The total returns will actually improve because most of them are fixed rates.
Yeah, I think it's important to know that for private credit, it's been consistently having a yield premium above the public credit, and that's the appeal of this segment. And another thing that's interesting is we believe that there will be dispersion in performance between different private credit managers as the cycle turns. For the good managers, they will be able to, because of the strong covenant that they have put with the borrowers, etc., they will be able to continue to sustain the yield premium and avoid, defaults and losses in their portfolio. And actually, for the good ones, as pockets of opportunities show, for example, if there is discounted assets, they will be able to go and pick it up, and that will add to the performance of the private credit funds. But for the lagging ones, that's when they will be tested as the economy slows down. And we believe that we do our due diligence here at Indawas, and we offer, the top tier private credit offerings to our clientele.
I'm gonna try and answer a question raised by someone who's not anonymous. So from Larry, says, with the cut likely to 4 to 4.5% by end of the year, and further cuts in 2025, but unlikely below 2%, how does that impact dividend stock income funds? So maybe Yulin's the better person to answer. I'll give it a go first. I think that dividend stocks actually have a somewhat similar dynamic to fixed income in the sense that again, from a discount rate perspective, the same dividend income will become more valuable when the interest rates are lower, right? So like for like, there is obviously better value when interest rates are down. Now, the slightly more nuanced part, though, is it really depends on which sector or which the company is in, because there are a lot of companies that give dividends. It could be a financial company, it could be a utility, it could be a REIT, it could be a lot of different things. So it also depends on what sector the dividend fund is. So it is a bit more nuanced than fixed income, but generally tends to be favorable for dividend income funds as well. Yulin, anything to add?
No, I think yeah, I agree with you, and also dividend paying companies tend to be more on the value side versus growth. So it's also a factor. It's also a question of how generally value stocks will perform against the growth stocks. I don't really know. I don't think there is a strong correlation, to be honest, or causality between interest rates and the performance of value versus growth. I think it still has to go back to the fundamentals of each sectors at different points in time and the companies as well.
I want to address another non-anonymous question.
Okay.
This time from Vincent. With the Fed expected to keep cutting all the way into 2025, actually, it's a question for you. How do you think the 30-year bond price will be?
It's a very difficult question because no one really knows how the 30-year bond price will move. A personal view is that it will probably not move down as much as what people might be expecting because of the long end kind of dynamics, and it's already moved down quite a bit. But to be honest, there's a lot going on, and I think what will affect it is really people's long-term expectation on growth and inflation, and also on the demand and supply dynamics on the long end. And we mentioned that there is a pretty high debt to GDP in the US. It seems that the market has been able to absorb the new issuance in treasuries market pretty well, such that actually the long end of the yield has been pretty contained. How that will play out in the future, we don't really know. But yeah, it's a very difficult question, and I'm sorry, I don't really have a very certain answer to you. I hope you're okay with that.
I think, I mean, I just add, again, I don't have an answer either, but I think whether it's the 10-year or the 30-year, if you break down the treasury, right, it's really a combination of inflation expectations and real yield.
Yeah.
So it'll also depend whether the inflation expectations are structurally moved or not, right? So currently, for example, the 10 years inflation expectation is between 2 to 2.5%. It's been like that for a very, very long time. And the reason is because that's the anchoring that the Fed has in terms of what inflation should be. Now, if that anchoring changes because we think there is structural inflation, then the 30-year investments will be different. But otherwise, like Yulin said, there is a normal kind of yield curve that the market follows, and also I think the 0% interest rates have never been the norm. So if we think that we're getting close to the neutral rate, and the yield curve normalizes, then it's hard to see the 30-year move too much.
Yeah.
Yeah. So that would be a kind of broad answer to that. And then there's been a question here. I don't know how much time we have. 11 minutes.
10 minutes.
Yeah, that's been here with 3 thumbs up for a while, but I thought I answered part of it. But let me just, which is the interest rate to stay high long term due to decoupling, budget deficit, de-dollarization, etc. Is it still good to buy bonds? And I think this is really a question on inflation. And maybe like I addressed a little bit in the beginning, I think there are different forces at play right now that impact inflation. One is, like you said, deglobalization, decoupling, etc., is inflationary in nature. But then all this technology that we're seeing, whether it's AI and so on, is actually deflationary in nature. So there are some structural forces that are at play. The stark kind of inflation that we see coming down really was the normalization of the supply-demand imbalance that we see, particularly in the labor side. So that's clearly normalizing. So, I think we are getting to a quote unquote more normal place. So from that perspective, again, with headline bond yields, relatively attractive, without rates having to shoot up again very quickly again for some reason, I think it still is a good place, to be in bonds, given that it gives you healthy income. Now, again, if your view is to compound, long-term growth, then equities is probably a long-term better option, right? So I don't think there is something that's completely abnormal about this economic environment. So with that, I think we should kind of look at that framework.
Mm.
Do you want to address the passive index collection question?
Yeah, of course. Yeah, I think so we do, so the passive index collection includes both equities and fixed income. There's not too much options on the fixed income side, to be honest. We have a global ag passive fund, and also a short duration one. And I think the passive index options are good if you want to stay passive in this current environment. And the short duration one will be one option if you want to go shorter duration, if you have a short-term horizon. And the global ag one will be intermediate duration, and it will be for those who are who are able to take on a bit more duration risk and go longer in that spectrum with a longer investment horizon as well. I think they're quite different in the sense that the ones that I have put on are more actively managed versus the passive ones. So it really depends on your view on whether you believe in active management in fixed income. If you don't believe in that, then passive will be the way to go, and they're cheap as well. But if you do think that active managers can add value in this environment, then it's also good to go with active managers.
I think there's maybe another question you could address, Yulin, on spreads being tight.
Yeah, I saw that one. Yeah, very good observation, and it's absolutely right. Spreads are trading tight. Of course, I think actually if the headline number is that it's tight, but there's a big dispersion in terms of spread level in IG. For example, if you look at different sectors, some sectors are actually trading quite wide, and some sectors are pretty tight. So it also comes down to the credit selection to pick up the ones still with value. And in terms of whether we still encourage investors to long bonds, yes, because actually the starting yield is really attractive. So it provides a really good cushion to any spread widening if it happens. Let's say if the economy weakens. With the starting yield of 5% in IG and a bit higher in high yield, if we see a bit of spread widening, it will still cushion the downside. And most likely investors will not see a very, very negative investment outcome. If you stay in IG or high yield for like the next 3 to 5 years, the one thing though is you can consider to be to stay high quality and more liquid, such that if there is any dislocation that happens, for example, in the lower credit quality part, you can then move your money from high quality to lower quality. But yeah, that's just one way that you can see it. But I think overall bond is still very attractive because of the high starting yield and because of the opportunities that active managers can actually pick up if you look under the hood of different sectors. Let me see whether there's any. Have we addressed the ones on tech and Max 7 stocks?
Yes, we did.
Okay. There is a question I remember on seeing how. Okay, so that one's answered. Is it better to buy U.S. government bonds or IG corporate bonds? U.S. government debt and printing money results in big depression. Better to buy gold, silver, and Bitcoin. Not sure about the second part, that the printing money is resulting in big depression. At least we're not seeing that in economic data, and growth is still relatively healthy, and the labor market as well. In terms of the choice between government bonds, IG corporate bonds, I think it depends on the return and risk. So government bonds is higher credit quality. So the chance of default is really, really low for US government. It's a matter of reputation for the government in order to continue to borrow money from investors. And however, the yield on it then is lower as well. So I think we're seeing 10-year US government around 3.7% as of this morning. So that's lower risk, lower return, if you think it that way. And if you are willing to take on more credit risk from lending to companies, so these are private companies instead of government bodies, then by taking on more credit risk, you actually pick up more yield as well. So generally, IG corporate bonds have 100 to 150 basis points, so 1 to 1.5% of yield pickup against government bonds. And actually, I would encourage you not to just focus on the US, but also look to the rest of the world and see broader opportunities there. And that's why we often encourage people to have a globally diversified portfolio. For example, we have been seeing emerging markets bonds benefiting from the US dollar weakness, and it has been the best performing part of the fixed income asset class for the past 2 months. So it's really important to diversify and not be too fixated on just US. Oh yeah, another point is, for example, high yield, right? US high yield spread is tight, but actually if you look at Europe high yield, it's not as tight as the US. So there are really like a very broad and liquid market for investors to look at, and it's not just the US.
Yeah, I saw a question on currency as well, which kind of for a Singapore liability-based individual, how should we think about US dollar weakening, et cetera? And just my answer is that's why we have a lot of our products, or most of our products, in SGD based or SGD hedge. So you don't have to go through the mark-to-market FX losses. There's indirect implications, but there's the direct ones are hedged. So if you again look at the historical rate cut cycles, clearly dollar was weak during those cycles. But what it also enables other countries to do is it makes them easier to go through their own easing policies, right? Which then kind of catches up as well. So if you compare to SGD, SGD has strengthened quite considerably recently against the dollar. So we don't do currency forecasts, so we don't know. But like the dollar has already weakened quite a bit against the SGD, and so that trend could moderate or continue for some time. But I think from an SGD liability investor perspective, you choose the SGD funds, then you can kind of mitigate some of that risk.
Yeah, actually, most of the fixed income funds on our platform is SGD hedged. So we do have the SGD hedged share classes. You do pay hedging costs on it, unfortunately, but you don't suffer the FX volatility. I wanted to address the question on, there's a private credit question on whether we foresee the default rate to go up in private credit. Yeah, a very good question. And I think for some private credit funds, the less well-managed ones, yes, default rate is probably going to rise, and we have been seeing more cases of that already. Even in the high yield market, default rate is still below historical average, but it is on the rise. However, I think the feature of private credit managers is that they have a relationship with the borrowers. And there are ways to work through if things really go south. That's why we have been seeing higher recovery rate historically in the amongst the private credit kind of assets versus public markets. And also another thing is that yeah, I think that's actually when we will see the dispersion between managers,
Yeah.
and the good ones will outperform.
Yeah, I would agree with Yulin. So, like for example, some of the managers that we have on the platform, a lot of them have very long-term track records in their closed-ended funds in the past. So it's really important to differentiate the ones that have the risk policies in place,
Yes.
and the relationship. But the other important thing to note is that actually a lot of private credit is at the highest end of the cap table. So what it means is that it's always the most senior secured, mostly senior secured, so that the credit quality, because these are private, are hard to measure in a public lens. But it's smaller companies, and yes, it could be more vulnerable during a recession, but it's more protected just from a capital stack perspective, and secondly, if it is a manager that has a track record of risk mitigation, then those are your two kind of ways, and then managers have diversification as well.
Yeah.
Those are your kind of ways to stay in that asset class even during a economic downturn.
That's true. I saw the YouTube comment from TC on. If you can reach out to one of our client advisors, they can assist you in providing the menu to you. Okay, I think we are on the time.
Yeah.
We are on time. It's 1:30.
Yes. Well, thank you everyone for your interest and spending your lunch time with us. I know this is a topic that's been of quite a lot of interest. Hopefully we were able to give you a little bit of color and help in terms of investments, but also we feel that there's a lot of money sitting in either fixed deposits or money market funds because of the favorable risk-free rates that we've seen. And I think it is advisable to try and move that towards risk assets, firstly fixed income, but then also equities as well, from a long-term perspective that matches your goal.
Yeah. Thank you so much for spending time with us. And if you have any unanswered questions, please write into our client advisors, and we will be able to get back to you.
Thank you very much.
Thank you.